All right, so you ready to dive into some dividend stocks?
Always ready to chase those dividends.
We're talking those stocks that feel like that safe harbor when the market's being, well, the market.
A little bit of predictability in an unpredictable world.
Exactly. And the goal here, what we're really after, are those hidden gems, the undervalued ones.
The ones with that potential for growth in 2025? Solid dividends plus a little capital appreciation, right?
Yeah, the 1-2 punch. So to get us started, you sent over this Market Beat article, and they highlighted a few companies, Chevron, PepsiCo, and Johnson& Johnson.
Big players. Household names, really. But the question is, are they positioned for a strong 2025?
Let's find out. So first up, Chevron. Everyone knows Chevron. I mean, you see that logo everywhere, gas stations, those massive oil tankers.
They're a dominant force in the energy sector, that's for sure.
And right now, seems like they're in a pretty interesting position.
The geopolitical climate plays a huge role with energy, right? And with all the current tensions, especially in the Middle East.
Yeah. You're thinking oil prices.
Oil prices, exactly. When tensions rise, those prices tend to jump, and that's where Chevron, with their massive reserves, well, they tend to benefit.
Makes sense. So there's that whole global context. But let's zoom in on their dividends specifically. The article mentioned their yield is sitting at 4.33%. Now, for those of us who don't speak Wall Street jargon, what does that even mean?
Think of it this way. For every $1,000 you invest, you get an extra $43 every year, just for holding on to that stock.
Wait, really? So just for owning it, that's it?
That's the beauty of a solid dividend yield. Of course, it's not always that simple.
There's always a catch, right?
Not necessarily a catch, but it's crucial to look at the whole picture. We also need to consider things like their payout ratio, which is basically the percentage of earnings they pay out as dividends.
So like if they're paying out way more than they're earning,
Mm-hmm.
that's probably not a good sign.
Exactly. It could be unsustainable in the long run.
Gotcha. Like spending all your money on a fancy dinner and then eating ramen noodles for the rest of the month.
That's one way to put it.
Okay, so we've got the dividend, the global situation, but the Market Beat article also mentioned this FTC approval, something about a merger with Hess Corp.
Right. That's a big one. Mergers and acquisitions, they can really shake things up. In this case, it points to Chevron's strategy for growth, for securing a larger chunk of the energy pie.
So bigger is better.
Not always, but in this case, it seems to be part of their long-term plan.
Interesting. Okay, so Chevron, potentially volatile, but also potentially very rewarding.
That's a good way to sum it up.
Okay, let's move on to our next contender, PepsiCo. Now, PepsiCo, they're like that friend who always shows up with snacks.
They're a beverage and snack food giant, and their reach, global. We're talking Frito-Lay, Gatorade, Quaker Oats, they're everywhere.
Everywhere. But how does that translate to their dividend?
Their current yield is sitting at 3.23%. Maybe not as flashy as Chevron's.
Okay, so not winning any yield contests.
But here's the thing, consistency. They've increased their dividend for, get this, 53 years straight.
53 years, seriously, that's longer than some companies even exist.
That's commitment. They're practically the gold standard for consistent dividend growth.
Impressive. But the world is changing, right? Consumer tastes are changing.
Right, which is why PepsiCo is adapting. They recently acquired Seed Foods.
Seeded foods, I don't think I know them.
They specialize in those grain-free, gluten-free snacks, tapping into that growing market.
Smart move. Gluten-free everything these days.
Exactly. They're diversifying, staying ahead of the curve.
Okay, but while they're exploring those healthier options, the article did bring up those economic worries, impacting lower-income consumers. Does that spell trouble for a company like PepsiCo?
It's a valid concern. Those impulse buys, those snacks, they can take a hit when budgets tighten.
True. People cut back on extras when times are tough.
But remember those lower interest rates we talked about earlier? That could provide some relief, maybe boost spending a bit. It's a balancing act for sure.
A lot of moving pieces. All right, we've tackled two very different companies so far, and I'm ready to unpack our final contender for this first part, Johnson & Johnson. They're like the ultimate healthcare companion, from those Band-Aids in your childhood to, well, maybe even those joint supplements you might need later on.
They've got their hands in everything, healthcare, pharmaceuticals, medical devices, consumer health products, you name it, they're probably involved.
And they've been in the news a lot lately, right? Something about lawsuits. Talc, I think.
Right, the talc lawsuits, those have been a challenge.
Definitely cast a bit of a shadow over them.
But remember that $8.9 billion settlement. It's a massive amount, but it does remove some uncertainty.
Like closing a chapter.
In a way, yes. It allows them to move forward. And speaking of moving forward, their future, it's looking promising.
Even with those legal battles.
Even with those, they're offering a 3.09% dividend yield, which isn't bad at all. But the real excitement, it's their drug pipeline. Over 100 drug candidates in development.
Wait, 100? Seriously?
Seriously. Now, not all of those will pan out, of course, but even a handful of successes.
Will be huge.
Exactly. The article highlighted their oncology drugs, Darzalex and Stelara, as current strong performers. And that oncology market, it's booming, hundreds of billions of dollars annually.
Wow, so they're playing in a big league.
And they're making smart moves. They're generating solid income now, but also investing heavily in future growth.
Planning ahead, I like it. But it's not all sunshine and roses, right? The article did mention some potential roadblocks, like Medicare's new ability to negotiate drug prices. How much of an impact could that have?
It's definitely a factor to watch. The Inflation Reduction Act introduced some uncertainty into the pharmaceutical industry as a whole. How those negotiations go will definitely impact Johnson & Johnson's bottom line.
So a bit of a wait-and-see situation.
Exactly. Potential for growth, but also some potential hurdles along the way.
Got it. So we've covered a lot of ground, but I need the SparkNotes version. If this were a betting line, what's that one-sentence summary to help someone decide if they want to learn more about Chevron?
For Chevron, I'd say energy giant, potentially riding a wave of geopolitical tension and rising oil prices, but be prepared for some volatility.
Short, sweet, and to the point. I like it. What about PepsiCo?
PepsiCo, adapting to those changing consumer tastes, banking on a potential economic upswing, but those consumer spending habits, keep a close eye on those.
Okay, last but not least, hit us with that Johnson & Johnson summary.
Johnson & Johnson. Navigating legal challenges and regulatory changes, but their massive drug pipeline, especially in oncology, could signal a very healthy future. Just, keep an eye on those Medicare negotiations.
Boom. 3 companies, 3 potential investment opportunities, all wrapped up with the key takeaways. But, and this is a big but, don't run off and restructure that portfolio just yet. What additional research would you recommend, before someone makes any big decisions?
Don't just take our word for it, or anyone's word for that matter. Look, it's your money, right? So do your homework. Those financial statements, dig into them.
It's like checking under the hood before you buy a used car. You want to make sure it's not a lemon.
Exactly. Look at earnings reports, check out their debt levels. Are they drowning in debt or are they managing it? Get a feel for their overall financial health.
Makes sense. Numbers can be revealing.
And don't forget about your own investment goals. Do these companies fit your strategy? Short-term gains, long game. That timeline, it matters.
It's easy to get caught up in the hype, but you got to stay focused on your own goals.
Exactly. And here's something I always emphasize. Think beyond the numbers. We talked about those global events, economic trends, even how consumer habits are changing. Those factors, they can make or break entire industries, not just individual companies.
It's all connected.
Precisely. So connect those dots. Look at the big picture, the political landscape, the economic forecast, what's happening socially and environmentally. All of that matters.
Okay, so to wrap up this first part of our deep dive, we've looked at Chevron, PepsiCo, and Johnson & Johnson. 3 very different companies, each with their own unique story. But they all have one thing in common. They're dividend payers with the potential for growth. Whether that potential translates into actual gains, well, that's where you, the informed investor, come in.
They really are practically everywhere you look.
From those little Band-Aids to, baby shampoo. It's like they've been there for all of life's moments.
They've got a pretty impressive reach across the healthcare sector. Pharmaceuticals, medical devices, consumer health products. You name it, they've probably got a hand in it.
Yeah, you're right. It's pretty remarkable. But lately, it seems like they've been battling some, negative press.
Oh, absolutely. Those talc lawsuits have definitely cast a bit of a shadow.
Yeah, what's the latest there? Have they made any progress?
Well, remember that $8.9 billion settlement we talked about earlier?
Yeah, that was a massive chunk of change.
It was a huge sum, but it was a crucial step towards putting those lawsuits behind them.
So like closing a chapter, moving on.
Exactly. It allows them to focus on the future. And speaking of the future, Johnson & Johnson's is looking pretty bright.
Even with all that legal stuff still hanging over them.
Even with that, they're offering a 3.09% dividend yield, which is nothing to scoff at. And then there's their drug pipeline. Over 100 drug candidates in development.
100? That's a lot of irons in the fire.
It is, but it's not about quantity. It's about having those shots on goal. The article highlighted their oncology drugs, Darzalex and Stelara. They're performing really well. And that market, the oncology market, it's absolutely booming.
Yeah, I've heard that cancer treatments, that's where it's at these days.
It is. It's a multi-billion-dollar market, and it's only getting bigger. Johnson & Johnson is in a great position to capitalize on that growth.
So even while they're dealing with those lawsuits, they're still making moves looking ahead.
Exactly. They're playing the long game, generating solid income now, but also making those investments in future growth.
I like that strategic thinking. But it's not all smooth sailing. The article mentions some potential bumps in the road, something about Medicare negotiating drug prices.
Right. The Inflation Reduction Act. That's the one. It's introduced some uncertainty into the pharmaceutical industry. How those negotiations play out is going to have an impact for sure.
So how does that affect a company like Johnson & Johnson?
Well, if Medicare can negotiate lower prices for those drugs, it could cut into their profits.
That makes sense. So it's a bit of a waiting game to see how it all shakes out.
It's exactly. Potential for growth, definitely, but also some potential speed bumps along the way.
Gotcha. So to sum it up on Johnson & Johnson, they're dealing with legal challenges, but their massive drug pipeline, especially in oncology, could mean big things down the road. But keep an eye on those Medicare negotiations because that could change everything.
You nailed it.
But before we get too far ahead of ourselves, let's switch gears to something a little lighter. Let's talk about PepsiCo.
From pharmaceuticals to sugary drinks and snacks, what a transition.
That's what I love about these deep dives. You never know where you'll end up. But PepsiCo, I mean, they're everywhere.
Yeah.
A true global giant.
They really are. Beverages, snacks, breakfast cereals, you name it, they've got it. And that reach is a big part of their success.
So how does a company like that stay relevant in a world where, consumer tastes are constantly changing?
It's all about adaptation and strategy. They're not afraid to evolve. Remember their recent acquisition of C8 Foods?
Oh, yeah, the grain-free, gluten-free company.
Exactly. They saw a growing market and they jumped in headfirst.
Smart move. Everyone and their mother is going gluten-free these days.
It's a huge trend, and PepsiCo is capitalizing on it. They're diversifying their portfolio, making sure they're appealing to those health-conscious consumers.
But they're not just about sugary drinks and salty snacks anymore.
They're still in that game, of course. But they're branching out, recognizing that consumer preferences are changing.
Makes sense.
Oh.
But speaking of those sugary drinks and salty snacks, those aren't exactly recession-proof products, are they?
That's a good point. When budgets get tight, those are often the first things to go.
People cut back on the extras when times are tough. It's just reality.
Right, so that's something to consider. Those economic struggles that the article mentioned, they could definitely have an impact on PepsiCo's bottom line.
So it's a bit of a balancing act for them. Writing those trends, but also being aware of those economic realities.
Exactly. They need to keep their finger on the pulse of both consumer behavior and the overall economy.
It's like walking a tightrope.
In a way, yes.
No.
But let's not forget about their incredible track record with dividends, 53 years of consecutive dividend growth. That's nothing to sneeze at.
That's true. That kind of consistency can be very attractive to investors, especially in times of uncertainty.
Absolutely. It provides a sense of stability and reliability.
Okay, so far we've covered two very different companies. Johnson & Johnson navigating the complex world of healthcare, and PepsiCo trying to stay ahead of those ever-changing consumer trends. Now let's shift gears one last time and talk about a company that's really at the mercy of global events, Chevron.
Ah, Chevron, the energy giant. Their fate is so closely tied to oil prices, which, as we know, can be a wild ride.
It's like trying to predict the weather.
Exactly.
Like that.
One minute it's sunny, the next it's a downpour. And
Yeah.
geopolitical events, those can throw everything off course.
So how does an investor even begin to make sense of all that uncertainty? What are the key things to look at when it comes to a company like Chevron?
Well, first and foremost, you have to understand that energy investing in particular comes with inherent volatility. Oil and gas prices, they're influenced by so many factors: global events, supply and demand, political instability, you name it.
So buckle up. It's going to be a bumpy ride.
Exactly. But for those who are comfortable with a little bit of risk, there's potential for significant rewards. One thing to look at is their dividend history. Chevron has a solid track record of paying dividends, and their current yield at 4.33% is definitely enticing.
It's a pretty good payout.
It is. But remember, dividends aren't guaranteed. They're tied to the company's performance, and as we've discussed, that performance can fluctuate depending on what's happening with oil prices.
This is kind of a gamble.
Not necessarily a gamble, but it's an investment that requires careful consideration. You have to be comfortable with the cyclical nature of the energy industry. You have to understand that those upswings and downswings are part of the game.
So you're saying don't put all your eggs in one basket.
Exactly. Diversification is key. And with a company like Chevron, it's especially important to do your due diligence, understand the risks, as well as the potential rewards.
So before you go all in on Chevron, you need to be prepared for a little bit of everything.
Exactly. The energy sector is not for the faint of heart. But for those who are willing to ride the waves, it can be very lucrative.
I'm sensing a theme here. It seems like with all of these companies, it really comes down to research and due diligence.
Absolutely. You can't just rely on gut feeling or what you hear on the news. You have to dig deeper, look at the numbers, understand the company's position in the market, and be aware of the potential risks and rewards.
So we're not just throwing darts at a board here.
Definitely not.
Yeah.
Investing is a calculated risk, and the more information you have, the better equipped you'll be to make those decisions.
It's been a wild ride, hasn't it? We've covered a lot of ground. 3 very different companies, 3 very different industries. But at the end of the day, it all comes down to this. Are these companies worth your hard-earned money?
That's the million-dollar question, isn't it? And the answer, as always, is it depends.
Here's that word again. It depends. But seriously,
Yeah.
we've thrown a lot of information at you. Dividends, yields, mergers, lawsuits. It can be overwhelming. So where do you even begin?
You start with research, you dig deeper. Don't just take our word for it, or anyone's word for that matter. Look, it's your money on the line. You want to make sure you're making informed decisions.
So no rushing out to buy stock just yet. What are some of the key things people should be looking at when they're doing their own due diligence?
First and foremost, those financial statements. They're your best friend. Think of it like getting a checkup at the doctor's. You want to make sure everything's in good working order.
So those earnings reports, debt levels, those are the vital signs.
Exactly. You can tell a lot about a company's health by looking at those numbers. Are they making money? Are they drowning in debt? Are they managing their finances responsibly? These are all crucial questions to ask.
Because sometimes those numbers tell a different story than the marketing hype.
Absolutely. Don't be swayed by a flashy website or a catchy slogan. Dig deeper.
Look at the cold, hard facts.
So we've got the financial checkup. What else?
Think about your own investment goals.
Yeah.
What are you hoping to achieve? Short-term gains, long-term growth, retirement planning. Your investment timeline should align with your goals. It's easy to get caught up in the excitement of a potential investment, but you got to stay focused on your own personal situation.
Exactly. And this is where I always encourage people to think beyond just the numbers. We've talked about global events, economic trends. Those factors matter. They can have a huge impact on entire industries, not just individual companies.
It's all connected, isn't it?
It is. The world is a complex and interconnected place. What happens in one corner of the globe can ripple out and affect markets and industries thousands of miles away.
So you're saying we need to be paying attention to the bigger picture, not just what's happening on Wall Street.
Exactly. Keep an eye on the political landscape, economic forecasts, social and environmental trends. All of these things can influence the market in ways we might not even imagine.
So much to think about. But that's why we do these deep dives, right? To give people the tools and the knowledge they need to make informed decisions.
Exactly. We're not giving financial advice. We're giving you the information you need to make those decisions for yourself.
And that's what it's all about at the end of the day. Empowering investors. Giving them the confidence to navigate the sometimes choppy waters of the market.
Exactly. Because knowledge is power, especially when it comes to your money.
Well said. Well, folks, we've reached the end of our deep dive into the world of dividend stocks. We've explored 3 very different companies, Chevron, PepsiCo, and Johnson & Johnson. We've talked about their strengths, their weaknesses, the opportunities, and the challenges they face. But most importantly, we've emphasized the importance of research, due diligence, and aligning your investments with your own personal goals.
And never stop learning. The market is constantly evolving, so should you.
Words to live by. Thanks for joining us on this deep dive. We'll see you next time when we explore another corner of the market. Until then, happy investing.